I do want to welcome in our next guest, though. Take a broader look at the markets and what we can expect for this week. Joining us now, Tim Nyland, CFA and Co-Chief Investment Officer at Synergy and Asset Management. Tim, great to have you on the show. I mean, we've seen a really nice rally in stocks this year, but we've seen a little bit of a stall over the past couple weeks. How are you looking at that setup as we're now pretty firmly in earnings season? Are you viewing this as a healthy pause here, or are you potentially seeing this rally running out of steam?
No, definitely a healthy pause. I mean, we've got a really nice broadening of the economic backdrop, and GDP growth continues to be solid. So we really just view this as a pause within a larger bull cycle, not anything like a systemic breakdown of any kind.
And Tim, as you're looking at it as a pause, what is it going to take for us to put the legs back underneath this rally?
That's a great question, actually. And what we've seen when we've had these types of recoveries in Q2 from a Q1 sell-off like we had, is it's normal to have some sort of consolidation, right? We've got a new Fed chair now. Markets continuing to test him a little bit. But we also have midterm elections. So we do expect a little bit of choppiness here through the midterms. But what we've seen in our research is that when we have this strength of a recovery like we had in Q2, this type of a pause really does set us up nicely for a good rebound in the second half of the year. So we're optimistic, cautiously optimistic. And obviously an Iran ceasefire would be just the cherry on top that we're looking for.
Well, it certainly would make things feel a little bit more secure and perhaps remove some of the volatility that we're seeing. I mean, we priced in peace so many times. Now even that feels a bit tenuous. I mean, as you look at it right now, Tim, I mean, we've got earnings season. Yes, we've moved most of the estimates to the upside. There's some really big expectations here, but we've already seen that the bar is very high for a lot of these names, and we've seen negative reactions to good numbers. As you look at earnings season, the uncertainty around the Fed, the potential to reignite inflation because we no longer have this ceasefire, although was just reading headlines this morning saying that there may be talks that are coming our way in the very near term. I mean, which of these matters most right now to the markets?
Yeah, I think the market is still largely pricing through a lot of what's going on in Iran, right? Obviously, if we get further escalation, that's going to be a problem. We really need to just look to the oil markets, look to inflationary expectations, right? We saw the Michigan Consumer Survey number came in positive. That was very helpful, as did the inflationary outlook for both short-term and the longer-term prospects for inflation. So, again, the economic backdrop is largely expansionary. We're looking really to Q2 earnings season for the guidance here from corporate boardrooms. We're looking for reaffirmation of capex spend. We've had some really sizable upside revisions to capex, now standing about $870 billion for 2026. Morgan Stanley last week or so just released new estimates for capex all the way from 1.2 trillion in 2027 all the way up to 1.4 trillion in 2028. So with earnings season, we're really looking again for guidance. We're looking for top line revenue growth, and we're going to be looking at that capex commitment.
All right, so let's talk about that capex commitment you just highlighted. We're at almost $900 billion in planned spend. The estimates, as you just mentioned, way higher than that even for next year. I mean, how are you looking at that? Is that enough to justify the valuations that we've seen? Are these companies getting too far out over their skis here, Tim? I mean, is the enthusiasm getting ahead of the fundamentals?
Well, what we're seeing, it's twofold, right? We're seeing profit margins for S&P companies, breaking records every quarter. So profit margins continue to grow. They continue to be robust. And that is really what's driving that, valuation expansion. Like you hear everybody talk about how expensive the market is. That's obviously, a large driver of that. Beyond that, basically what we've got with AI capex is we just need that affirmation that growth is going to continue. And again, the real issue is that we've got a concentration risk now related to GDP, in that capex is representing now a larger and larger portion contribution to GDP. The average contribution to GDP for business fixed investments from 2020 to 2025 was only 0.4%. And as of the latest Q1 GDP read, that has risen to 1.4%. So consumption as a whole has dropped. The average of that was 1.7. It's now down considerably, down to about 0.4% contribution. And now we've got government spending kind of picking up. That traditionally has averaged in about 0.2% contribution to GDP. We're now at 0.7. So the two largest contributors to growth in the United States are now basically capex spending and government spending, and consumption has slipped to number 3. So it is a little bit of a concentration risk, and that's what we've got our eyes on.
And Tim, with concentration risk, I mean, we talk about these mega cap names here. How are you looking at the Mag 7 as they fit into this picture? I keep hearing the Lag 7 conversation. They've contributed very little to the rally that we've seen. I mean, is it time for them to step back into the sun, or do you expect this underperformance to continue?
No, we think so. That's a great question, right? The Mag 7 earnings are forecast to be roughly 38% growth in 2026, and they haven't contributed for the first half of the year. So the real laggards in that group are going to be, your Microsoft, your Meta, your Tesla. Apple's been a fabulous performer, but we do expect that Mag 7 to rebound into 2026 and finish strong.
Well, we'll find out on Wednesday when we hear from the first names in that group. Tim, really appreciate you joining us this morning. Tim Nyland, Co-Chief Investment Officer at Synergy Asset Management. Thanks again for joining us this morning. And